All right, hello everyone. Thanks for joining the webinar today. My name is John Petrides. I'm a portfolio manager and managing director with PointView Wealth Management. Joining me today is the founder, CEO, and president of PointView, David Dietz. The timing and the topic of today's webinar is the longest bull market in history. Is your portfolio prepared when it stops? So given the recent volatility in the market, we think that this webinar is quite timely, and we could spend hours on this topic discussing it, but we think we've condensed this presentation into a handful of slides to make it as succinct as possible. But obviously, if you have any questions following the call, please let us know. Just a couple of housekeeping issues. If you look on the upper right-hand side, you will see an icon for a chat feature. That's a private chat, so upon Q&A or any questions or comments you have, please please type it in, and we will get to it at the end of the presentation. Also on the right-hand side, you will see a polling section. There's a question for you. We'd love for you to participate and let us know what you're thinking. And the question is, which asset class do you find the most attractive today? And the choices are stocks, bonds, cash, gold, real estate, or other. So we'll let you know the results of that poll by the end of the webinar, so please participate in that. Again, today is Wednesday, October 24th, 10:30 a.m. Eastern Time. So why don't we begin? David, let me interrupt you quickly 1 second. I think you're having some technical issues on your sound. Judging by everybody who's participating in the chat room, they can't hear you, they can see you. So when you get that fixed, I'll pick up where you left off. So thanks everybody for chiming in. So obviously the background that David's providing is PointView's been around for 25 years now. We're celebrating our 25th year. We're based in Summit, New Jersey. And the three key ingredients of us is that we're independent, so we're not affiliated with any other firm. We're on our own. We're fee only, not fee based, so we don't sell commission based products. We charge per percentage of assets under management. And of course, we're registered with the SEC, so we're held to the highest fiduciary responsibilities of the regulatory environment. What we do provide for our clients is an end-to-end wealth management service. So we're creating customized investment portfolios of individual stocks and bonds, and then overlaying that with financial planning. So the left hand is talking to the right, and we give a 360 holistic view on your individual situation. We do believe each individual client is their own unique person, and therefore they shouldn't be commingled or dumped into a model along with everybody else. We do manage for tax efficiency. Clearly, as we get closer to year end, we try to make sure that we maximize the client's tax situation. Our minimum is $500,000 for all accounts aggregated. We do custody at Fidelity. Our fee is 1%, and again, that includes in customized investment management plus financial planning. Or if you just need financial planning services, obviously Claire Toth, our financial planner, can create an individual plan for you. Over the 25 years, PointView has grown significantly. We've had great success being recognized by CNBC as one of the top 100 independent fee-only registered investment advisors in the country. And over the summer, we were recognized by Financial Advisor Magazine as one of the top IRAs in the country as well. So as David gets his mic set, I'm going to start with the breakdown of this presentation is going to be, yes, we're talking about the bull market given the volatility, and the question is, can it last? And the answer is yes. There are reasons why it can last, but there are also ways that we're going to put forth where it could get disrupted. But let's start with, we're lapping the 10th anniversary of the financial crisis, and who would have thought that this would have been the market return 10 years ago? I mean, 10 years ago, Congress was voting on TARP, the housing market was in shambles, Lehman Brothers had just failed, Merrill Lynch was taken over by Bank of America, Wachovia was taken over by I think Wells Fargo. I mean, we were in an utter state of chaos, and yet eventually the market found the floor, and we're in a significantly better shape today, which we're going to discuss, than we were 10 years ago. And although this has been often regarded as the most hated rally of all time, stocks have had a historic run over the past decade. We are now 3,500 plus days without a correction defined as a 20% drop from peak to trough. That is enormous. In fact, we're now on record for the longest bull market in history. So we'll go through why that could continue. But as we all know, everything must come. No good things last forever. Everything must come to an end at some point. So can the bull market last? Well, here are a couple of reasons why. One, the economy is healthy. So this chart here shows 4 various ways from a macro standpoint of why particularly the U.S. economy is doing quite well. Car sales are at about almost 16.5 million on an annualized basis. That's slightly above average of where we've been for the last almost 20 years. Manufacturing trade inventories are healthy. Housing starts on the bottom left there, we're at about 1.2 million starts on an annualized basis. This is, look back where we were in 2006. The average was we're at about 1.3 million. We were overbuilding for 6 years straight by almost 50% more than where we should be. So we've worked through all that inventory. Credit is flowing again. And the housing market is quite stable. And obviously capital good orders, as you're seeing over here, is about in line where we've been over the last 20 years. So the macro story on the U.S. is quite strong. More importantly, the consumer and the banks are healthy. Go back to 2008, 10 years ago, the banks were levered to the gills with all the subprime mortgage debt. And as that was collapsing, so was the value of the assets on their books. Well, that's no longer the case. The banks have been regulated to almost utility-like standards. We're all well aware of that. Their balance sheets are probably the healthiest they've been post-World War II. They're required to keep a tremendous amount of capital on the books to buffer any losses. They are stress tested annually by the Federal Reserve. So now you look at where the consumer is. Well, it's well documented that we are at full employment here. And wage growth, although not as fast as many would have liked to, many have expected, given how tight the labor market is, it's growing at 2.8%. So the consumer is doing pretty well. And that also means that if people have jobs, they're paying off whatever loans they're taking loans to reinvest in their house by doing either buying cars or fixing up their homes or taking on mortgages to buy a home, which is good. And it also means that the banks are having their loans paid back on time. In fact, the banks have reported a pretty strong earnings season so far, and their loan portfolios are quite healthy. Corporate America is healthy. We're in the thick of earnings season right now. Earnings expectations are for 20% growth year over year. So far, those companies that have reported, we've had about a 70% beat rate so far on Wall Street analyst expectations. You have some cyclical companies that are feeling a little pressure. Obviously, the US dollar has been strong. Commodity pressures with oil prices being higher and tariffs being higher have been an issue. But by and large, companies are doing quite well. Sales are up, and if you look here, we're at really high margins from a profit standpoint. So, the U.S. economy is doing well, the consumer is doing well, banks are well capitalized, and corporate America is quite healthy. What you're seeing on certain stocks when you see certain volatility is really companies, if they miss, it's because they missed very high expectations. I mean, if companies grow, or if the companies in the S&P 500 grow earnings 18%, that's still a really strong year. It may not be as strong as the 20% that analysts are expecting, but it's still a quite healthy growth rate. Now let's look again. Although interest rates are rising, they're still relatively low where they have been historically. Plus, inflation is relatively low. I mean, many of you on the call here will remember where we were in the early 80s, or where interest rates were back then. We're at about 3.25% today, and inflation is hovering around 2.5%. So we're not in, although interest rates are rising, although there's fears of inflation rising, corporations can still do business in very profitable ways. To put that in context, before the housing bubble burst and before we hit into the financial crisis in 2006, the Fed funds rate was around 5.5%, so significantly higher where we are today. And valuation on stocks aren't that expensive. This goes back to September 30th. Clearly, with the market sell-off, I mean, the S&P 500 is down about 8% since the start of the fourth quarter. Valuations are cheaper, but we're about historically average here on a price to earnings multiple, PE multiple, as you can see here. We're at about 16 times going back to 1990. So, and this involves a period where, where the U.S. economy is more service-based rather than manufacturing-based. So when you look at historical valuations, a lot of times they get thrown out of context because the U.S. economy is significantly different today than it was, say, in the 1960s and 1970s. So valuations aren't extended. We're not in bubble territory like we were in the dot-com. We're definitely not table pounding cheap as we saw maybe 10 years ago. We're sort of right in the middle. And given fundamentals and given where interest rates are, that's still an attractive environment for stocks to do well. But as we know, nothing lasts forever. All good things must come to an end. And insert your favorite cliche here, because the party can't last forever. So we're in this environment where things look good, but we're also not Pollyannish and understand that the shoe can drop. So let's talk about the bear case. Let's talk about the other side. First of all, we've been in a period of unprecedented monetary stimulus. I mean, look at this here. Look at where interest rates were for a decade, right? And rightfully so. I mean, the Federal Reserve has thrown the kitchen sink at trying to resuscitate the economy, which could have resulted in 1930 Great Depression type of fashion. And they've gone to unprecedented lengths to save the global economy. And not just the US, this is done central bank. This is done globally. I mean, we're seeing what the European Union has had to do post the Greek debt disaster. We're seeing issues in China, what they had to do the last 3 years to stimulate their own economy. All right. So the fear is now, though, of why this has rattled the markets is right here. So this blue line here is expectations for where the Fed is setting their dot plot. So the Federal Reserve is saying by 2020, 2021, they want to be at about 3.4% or so, 3.5% on the Fed funds rate. And now we're between 2 and 2.25, right? So you have another 1.25% increase. However, the market is this line. So the market does not expect the Fed to get there that fast, or is not expecting the economy or inflation to be that much of an issue. So where volatility comes about in the stock market and even in the bond market is if market expectations are wrong and the Fed is right. Right? So if the Fed has to raise rates faster than expected, if inflation kicks up faster than expected, right? That's where volatility puts into the market. That's what we're seeing today. That's why the Fed funds rate has risen, and that's why bonds are down for the year, is because expectation is that wage growth is going to continue higher, and that's going to force the Fed to move in a more aggressive fashion than what the market is expecting. All right. The second issue is the U.S. debt situation. We're now at about $21 trillion in debt. The U.S. economy is about 15 trillion. So we have, call it a 1.2, 1.3 times debt to GDP. The U.S. just took on a significant amount of debt to finance the tax cut that went through for this year. Time will tell as to how stimulative that will be. So far, it has been. So the question is Congress going to be responsible enough to bring down the debt situation? So this is something that we're keeping a keen eye on because look at even the forecast. By 2022, it's expected that the U.S. is going to have $26 trillion in debt, which is significant. And if the economy were to fall into recession, and that debt level continues to increase, that's going to cause for concern. Now we have to talk about China as well. As you can see here, China is now 15% of global GDP and growing. So it is the second largest economy in the world by a single country behind the United States. The EU collectively is about 22%. So whatever happens in China is going to impact the rest of the world, particularly the emerging economies. As China sneezes, the rest of the world could catch a cold. and we saw some hints of that quite recently. You know, can the Chinese economy fall into recession? You know, that's a bit dramatic here because they grew their economy at 6.5%, was quite recently reported, but the expectations were for 6.6%. And 2 weeks ago, the Chinese central bank actually did quantitative easing. They lowered their reserve require ratio, which is a form to stimulate their economy. So why, if their economy is growing 6.5%, would they need to stimulate it? So is something else going on there? Clearly, tariffs are having an impact. And the Chinese stock market is down over 20% for the year. So clearly, the tariffs that the U.S. is imposing and threatening to impose more upon China is having its impact on the economy. So then it brings us to the next portion here within China is, what is their debt to GDP too high? You know, I mentioned the U.S. in the amount of debt that it has, but China has had, you know, arguably probably the fastest growth in debt to GDP in like the history of mankind. You have, look at this increase here from about 2012 to where we are today. You've gone from about parity up to about 275% debt to GDP. That's tremendous. And that's just what we know of, right? I mean, we all, to a degree, have to take the data that we get out of China to a grain of salt, you know, with some speculation. So if the economy is slowing and they have a massive amount of debt, you know, could the Chinese economy buckling, and what's the impact to the global economy? Midterm elections are coming up. Clearly, there are fears that, from a market standpoint, that if the Democrats win the House and possibly win the Senate, does that derail the pro-Republican, pro-business agenda that the Trump administration has brought forth? Clearly, the market has responded favorably to the fact that the Trump administration is pushing forth deregulation in the financial and the oil industry. Did the corporate tax cut so companies can repatriate cash, lowered the corporate tax rate for U.S. companies to make them more competitive globally. So clearly that agenda, the market could be fearful upon the outcome of the midterm elections. You could see some volatility because is that now derailed? Obviously, you know, there's a lot of fears of within the media and headlines that you know, does something happen to President Trump before his upcoming president election in 2 years from now, where he may have to be removed from office. Again, this is another risk in terms of I'm not sure about the probability of any of this, but it is a factor that needs to be considered in what could amount to a derailment or a market correction. The timing of this is quite interesting, of this next slide, because the tech sector has been by far the best performing sector in the S&P 500 over the past 2 years, and of course led by the FANG plus Microsoft stocks. So of course this is Facebook, Amazon, Apple, Netflix, Google, and Microsoft. I mean, those companies have been dominant performers, and as we all know, the S&P 500 is a market cap weighted index. So the higher that those stocks move, the greater their market cap, the greater percentage they are for the overall for the overall index. So, for example, Facebook, Apple, Amazon, Microsoft, Google make up about 16% of the S&P 500. That's amazing for an index that has 494 stocks into it. So the movement of any one of those stocks is going to dictate where the overall market goes, right? That is a big deal. And we've seen that, particularly over the last couple of weeks, tech, which, you know, we think from a valuation standpoint is quite extended, has really rolled over. The NASDAQ was down about 12% or 10% coming into as of last night's close, and that has pulled down the market. The S&P is down recently since the end of the fourth quarter, mainly because tech has been a major drag on the index. You know, look at Apple. Apple is 4.3% of the S&P 500. That's larger than 3 sectors. It's larger than the REIT sector, utility, basic materials sector, and it's almost as large as the energy and the consumer staples sector. Energy is only 6% of the S&P. Consumer staples is 6.7%. That's amazing. So you have one stock that is so dominant, it's almost larger than a group of stocks from in a whole sector, and we think that poses significant concentration risk, and you're starting to see that play out now. Parts of tech are bubbly from a valuation standpoint. This is not 1999. We don't think that most of these companies are well established. And valuations, although we think they're expensive, they're not like where Cisco was in 2000, or even where Microsoft was in 2000. But we do think that their valuations are expensive. We do see the market in a de-risking mode right now, and valuation is starting to matter. And where valuation has been the frothiest, it has been in the tech sector. So what do you do now? Right? We're in this funny period of, where stocks are not too hot and they're not too cold. We're in the longest bull market in history, following the most severe sell-off and recession since the Great Depression. There's a lot of skepticism in the market. People are waiting for this next shoe to drop. But what do you do? Where do you go from here? And the first mantra is don't try to time the market. Trying to change your asset allocation today because we've been down a little bit, or trying to be overly aggressive to say, okay, the bottom is in, let's go all in, is not the right action to ever take. Timing the market's impossible. What you need to do is focus on your own situation. What's your risk tolerance? What's your time horizon? What's your tax situation? What are your income needs? Are you looking to retire soon? Have you just retired? Focus on that rather than where the market is. Reevaluate your current asset allocation. Do you know how you're allocated across all of your accounts, your taxable accounts and/or your tax sheltered accounts? How are you allocated from a stock, bond, and cash standpoint? Do you have so really refocus after this sell-off as to where you are, and make sure you know where your current allocation is, and make sure that's aligned with your overall investment goals and objectives. Are you too far over your skis in one asset class, sector, or stock? This goes to the fact that tech has risen so much and has become such a dominant sector in almost every index ETF fund or in an actively managed mutual fund, for example. So if you own a lot of mutual funds, do you know what your exposure is to Apple? Do you know what your exposure is to the FANG stocks? I mean, most likely, if you have a lot of mutual funds, you have a significant amount of overlap. Are you diversified accordingly? Have your assets gravitated to one sector where it's just too dominant and it controls the entire flow of your overall portfolio? Are your assets liquid? Right? One of the great lessons learned from the financial crisis in 2008, where many people had their assets locked up in hedge funds, or they were locked up in alternative strategies and private equity where they couldn't get to their assets to liquidate in time, or to redeploy the funds if they wanted to take advantage of the stock market sell-off. So liquidity in times like this becomes a premium. You want to have access to your funds in a short amount of time, that if the market moves in one way or the other and you need to rebalance, you have the ability to do so. And obviously diversify. And like I said, this is not a time where stocks are table pounding cheap. It's not a time where, it's all systems go in the bond market. It's not a time where you should be 100% cash. We can make the bull and bear case for all three asset classes. So the time, what should be done now is to make sure you're spreading your bets, right? Stocks are attractive. We gave the bull case of why we think stocks can run higher, but there clearly are risks. Bonds, there are some headwinds, but yields on bonds now are more attractive than any point they have been over the past decade. So why are people who have been hunting for yield over the past 10 years are running away from bonds now? And you're seeing bonds have actually rallied over the past couple of weeks as fear has creeped into the market. So although the market has been viewing a bond as a four-letter word, it has been a place of safety in a time where the market has been overly focused on interest rate risk. Okay, so now more than ever, focusing on diversification and spreading your risk is crucial. Emphasize gold too. Gold had been crushed all year long on the back of the Fed trying to slow inflation by raising their interest rates, and gold has been a big underperformer up until about 2 weeks ago. In fact, since the start of the fourth quarter, gold is up about 4%. All right, so even having an allocation to gold helps protect against that black swan unforeseen event. All right, focus on the long term. I love this chart. All right, this goes back to, this is the S&P 500 going back to 1900. You know, it is not uncommon for the market to sell off, call it 7 to 10% peak to trough during the course of a calendar year. That's just normal volatility. You know, 2017 was an abnormal year because the market, the S&P 500, never finished negative at any month during the course of the year. It finished positive every month. That leads to people getting complacent. It leads to excessive risk taking, and we're seeing those investors getting shaken out of the trees in 2018. So although there's, some volatility now in the short term, you should remain focused on the long term and what your individual goals and objectives are. I love this chart though because it shows you what the market has done, and we've been through a lot of stuff over the past 118 years. So that wraps up the formal presentation. Obviously, we could spend hours on this topic and presentation. We are, sensitive to your time. We'd love to continue this conversation with you. If you need help reviewing your asset allocation to determine if you are too far over your skis, obviously give us a call. We'd love to chat with you. If you have questions regarding volatility in the market, if there's something following this call that you're wanted to speak in more detail, give us a call. Now let's go to, I'm going to open up for the Q&A. I want to go to the poll first. So again, which asset class do you find the most attractive today? 71% of you said stocks, 14% bonds. Not one of you voted for cash, gold, or real estate, and then other got 14%. So that's quite interesting that despite the recent volatility, a large majority of you are still bullish on the stock market. Going to some of the questions. Let's pick out some of these. Do you see the market correcting like 2008? My answer is no. We don't see excess in the system. It's not like 1999 where there was excess in valuation in tech land. It's not like 2006 where we were building 2 million homes on an annualized basis and people without an income were able to get a mortgage and buy a house. I think Bitcoin was probably the excess in 2017. People were trying to view Bitcoin as the next alternative uncorrelated asset, meaning if interest rates rise, bonds would go down, stocks could go down. You don't want to own cash, so you want to own something uncorrelated to the overall market. So investors were bidding up Bitcoin. Well, Bitcoin is down 70% this year, 70. And I'm using Bitcoin as the just example of cryptocurrencies. So no, we don't see the market dropping 37% like we do in 2008. But there is cause for concern. But we could also see the market rallying here. Again, I think we're sort of in this funny time here, and that's where I stress diversification. Just here's another question. Actually, should I invest in Bitcoin? So I think I just answered that. No, we would stay clear of Bitcoin. Again, Bitcoin was originally established as a medium of exchange to replace the dollar, a form of currency, but clearly that is in its infant stage, and given the sell-off and given the regulatory pressures, there clearly is no concrete future if Bitcoin will stick around or not. Should I invest in marijuana stocks? Obviously, marijuana stocks have gotten a lot of play in the press clearly what's going on in Canada, and there are certain states in the U.S., i.e., Colorado, that have benefited from the tax dollars that legalizing marijuana has produced. There's a lot of thought of this giving strength to a whole new budding industry, no pun intended, can create a lot of jobs. But in terms of marijuana stocks, we equate them to the solar industry of 2007. What do I mean by that? In 2007, go back to oil was $120 a barrel, peaked at $147 a barrel in July of 2008. We were paying $5 per gallon at the pump to gas up our cars. And there was this massive wave to alternative energy, solar panels, wind farms, clearly natural gas, nuclear. And you had this major push. And what happened to all the solar stocks and all the alternative energy stocks? They went through the roof. Well, here we are 10 years later. And I could say that from my vantage point in New Jersey, there are more homes with solar panels on it, but it's not everywhere, right? So, and most solar stocks now, with the exception of maybe First Solar, are dollar or a penny stocks. They're down significantly from the levels of where they were in 2007. There aren't many survivors. I view marijuana stocks in the same way. That yes, there's a lot of hype, there's a lot of excitement about the future. And yes, probably marijuana will still be here 10 years from now as some form of industry. More states will probably adopt it to legalize it. It will create more tax dollars. There's a lot of good things there, I think, from an economic standpoint. But there will be winners and losers. And I think right now it's too early to tell who that will be. You need this to shake out a bit further. Let's see some other questions. What is your long-term view on stocks? So this is a good question. Entering into the millennium, stocks had done about a 10% total return, annualized rate of return. Total return meaning appreciation plus dividends. I think Warren Buffett summed it up nicely coming into the millennium. Don't expect to see a 10% annualized rate of return for U.S. stocks again over the next 100 years. In fact, it should be more muted around 6 to 8%. And I think we agree with that. The U.S. economy is significantly more mature. Clearly the higher risk you take in terms of smaller cap or mid cap stocks will probably have higher returns than larger cap stocks over time, but clearly there's more risk associated with that. So we fall in the camp that stocks can, on a total return basis, do about a 6 to 8% total return, looking out in the future. Should you use a portion of your assets in single inverse ETFs? So I guess my answer to that would be no. We invest in individual stocks and bonds. I don't like those inverse ETFs. They're typically expensive because you're dealing with clearly some financial engineering there. I think that I understand the point of the question, I think, is to provide a hedge to the underlying portfolio. So if you have an inverse, S&P 500 and, the market goes down, at least you're protected on the downside. We would argue that bonds have proven to be the safest form of and cheapest form of insurance that you could have in your portfolio to protect to the downside. In fact, in previous webinars, we've shown slides that go back to 1929, and I think there's only 4 periods since 1929 that bonds were down the same year that stocks were down. Meaning, when the stock market goes down, the bond market, out of the past, I guess that's 80 years or so, with the exception of 4 years, has been up. So we think fixed income is a good way to protect to the downside. Should you invest in CDs right now? So clearly, with short-term interest rates rising, CDs have been more attractive, particularly for those investors with a low-risk profile that have been starving for yield. The problem with CDs is twofold. One, as I mentioned, you want to have access to liquidity in this environment. And when you lock up in a CD, let's say a 2-year CD, you're confined to your asset is controlled by the bank. So you can't get out of it if you need that cash flow. So we don't like the fact that if you did break the CD, then you're subject to a penalty. So we don't like the fact that your asset is locked up. The second thing is if you own a CD, particularly in a taxable account, and let's say you're getting 2% return, well, the interest income is still taxed at your ordinary income rate. And when you include inflation, which is running around 2.25% or so, your net real return really isn't that great. So on the surface, it may seem a bit more enticing just because of how low things have been for so long. We would continue to avoid CDs here. Should I buy an annuity? Isn't a question here. We did a webinar. If you missed that, go to our website right here. Here we go. Go to our website. You can see the webinar that we did last month, which were the pitfalls against annuities. We're not big a fan of annuities. We do not sell annuities here. Again, for many reasons. Again, annuities lock up your money. They're not great vehicles to pass on to the next generation. They're fairly tax inefficient when you're annuitizing it, when you're taking the income. And there's a significant amount of layer of fees that distort the net yield. So you have surrender charges, there's lockup fees. If it's a variable annuity, that's invested across many mutual funds, which all have their own fees. So no, we're not big fans of annuities. Let me see. So one question here, and again, if you want more information, can you explain an inverse ETF? It's basically an ETF that does the opposite of it's almost like shorting a certain position without having to go through the process of shorting it. So for example, if you buy an index S&P 500, you are in theory owning the market and hoping that it goes up. The inverse S&P index is that you profit on the index going down. But there's a lot of stuff that happens behind the curtains in order for that to happen, and those are very dangerous investment products. In fact, there's now like 2x and 3x inverse ETFs, which tries to amplify the returns 2 times or 3 times. And again, we would advise staying away from those type of vehicles. I mean, at the end of the day, we believe that if you know what you want to achieve, if you know your time horizon, if you know your tax situation, if you know your income needs, and we develop the right strategy of stocks to bonds to cash for you, and you live within your means to meet those goals, you'll do okay. We don't think anyone needs to get into very esoteric, expensive products to achieve those simple goals. It's simply knowing what you need and what you want, communicating that appropriately, and us going out there building the portfolio in your name in a tax efficient manner to meet those goals. Well, I don't see any more questions. We really do appreciate all of you joining this call. Again, timely. We will send out a replay to everybody. There is a feature that when you do sign up for webinars, where you could automatically sign up for future webinars. So when you see our next one come out, which we'll do in November, click on that feature and then you'll be automatically renewed every single time. So again, thank you everyone for joining us. Please give a call to the office if you have any other questions, or obviously send us an email. You can see our firm-wide email address right here. We'd love to talk with you, chat with you, and again, help you sort of navigate through these recent volatile times. Have a great day, everyone. Take care.